as an introduction to this next segment of materials, let's go through a little story about a small but successful manufacturing company, and let's actually make you the owner. You rent this factory, and you rent all of the equipment in the factory, and inside that little factory you produce 4 different products. Your brother actually happens to be a fantastically talented accountant. His specialty is financial accounting, so he actually prepares the financial statements for your company. Your company is audited, so you feel good about the information in the financial statements. What you're looking at up above the blue box here is a summarized income statement for the most recent year. To prepare these financial statements, your brother, the accountant, traced all the materials and labor costs among the various products, and he properly allocated the overhead to the products as well. In this case, he just allocated it evenly, and given the items being produced in this factory, that was a reasonable method. So you're the owner, and you're looking at this financial statement, and you're really concerned because net income this year was only $20,000, and maybe that's way less than in previous years. So you ask your brother to bring you more detail, and you basically ask him to give you an income statement for each product line. Your brother runs some numbers, and he comes back with a perfectly presented summary of net income by each of the 4 products. Let's take a look at it. Here it is. You can see that product A produced a profit or net income of $15,000. B produced net income of $10,000. C produced net income of $5,000. And product D isn't looking so good. Product D actually produced a loss of $10,000. If you add these numbers going across, you can see that they definitely add up to the numbers in the total column. Your brother, the accountant, and you feel really good about the information you're looking at. So there's you, the owner, your brother, the accountant, and maybe a couple of other sort of top people in your company that you trust, and you're all looking at these results that you got. What do you think your decision's going to be? What kind of action item would result from looking at this information? Well, I'm going to suggest that a prudent person sitting in that boardroom looking at these numbers would say, let's stop producing product D. We're losing $10,000 on it. Let's get rid of product D, and just by doing that, we can increase our net income by $10,000. Let's look further into that statement and into the results. Remember that the financial statements have been prepared in accordance with GAAP, so the accountant has properly computed the total cost of goods manufactured during the period as the cost of materials, labor, and manufacturing overhead. All of those costs have been allocated to the various units produced, and then they've properly charged cost of goods sold with the cost of those items that were sold, and they've left the cost of the items still in inventory on the balance sheet in the inventory account. So all I've done here in this second segment of data is I've broken up the term cost of goods sold, which is what you would normally see on financial statements, into 2 different categories of costs. I've put materials and labor on one line, and I've put overhead on the other line. You can't really see my full word here, but next to overhead, this would say that's mostly rent, because remember, most of the manufacturing overhead actually related to rent paid on the facility and on the equipment. So the $355,000 and the $100,000 here are the same as this $455,000 up here. But now we've got a little bit more detail as to the types of costs in this income statement. So let's see if we can think about our decision again. Once again, we have the same numbers here on the bottom line. Net income going across still shows that loss for item D, obviously, when we drop item D from production. Okay, well now I've uncovered the results of dropping product D. When we drop product D, this $95,000 of revenue goes away. The cost of all of the materials and labor would also go away, so you can see materials and labor costs have dropped from $355,000 to $275,000. But But the cost of the overhead would not go away. Remember that what this overhead actually is rent being paid on the small factory and the equipment. Whether or not you produce product D, the rent for that factory is still going to be $100,000. This $25,000 that's listed here because it was allocated to product D properly, that $25,000 is not going to go away. That cost behaves differently than costs like materials and labor. Instead, that overhead cost would just be allocated among the remaining units. So now you can see the overhead cost allocated to our three remaining products is $33,334. Let's assess bottom line here and see how we did. We were expecting net income to go up to $30,000 when we dropped that product that was losing us 10 grand. Well, you can see it didn't happen. In fact, the situation is even more dire than it was before. Now net income is only $5,000. So picture us, the same group of people as before. We're all sitting around that table. You're the owner of this business, your accountant, and some top-ranking people are there. We're looking at the income statement again and wondering, what do we do? Well, now we say, oh gee, product C, that one's losing $3,300 a year. Let's stop producing product C. Well, maybe you can see where I'm going here, but let's go ahead and take a look at the results. So roll forward to the future again. We've stopped producing product C because we thought that was the prudent thing to do based on our financial statements prepared in accordance with GAAP. We're only producing products A and B. So the revenue and some of the costs related to product C have disappeared. But remember, that rent cost, that cost is still there. That cost doesn't change. We have to pay rent whether we produce anything or not. We call that type of cost, by the way, a fixed cost. So rent, that fixed cost, hasn't changed. It's $100,000, and now we allocate it again evenly between our two remaining products. Have we helped ourselves? No. As you can see, now we're actually operating at an overall loss of $25,000. Both of our products are losing money. What's happened here? This is actually an example of what I would call a death spiral situation. Management used financial accounting information, and it was fine financial accounting information, but that financial accounting information didn't clearly convey to management the nature of the cost they were considering. It wasn't really organized to help them recognize that when certain products went away, not all of the costs associated with that product for financial statement purposes would also go away. So if management kept making that kind of decision, they would actually kill the business, and that's why we call it a death spiral. Now, does that seem really impossible, really foolish that somebody would do that? Not really, unless management has some understanding of costs, and what we will study in this session, some understanding of cost behavior. It's really easy to make bad decisions. I think the single most important takeaway from this course will be the idea that anyone making decisions with accounting information needs to understand cost behavior. So that's what you will be studying in this unit and in several others going forward. I hope you enjoy it.